A great pleasure to bring on board Dr. Fereidun Fesharaki on ET Now. Dr. Fesharaki is one of the foremost authorities on oil. His analysis in 2008, when oil prices were at $100 plus or $130 plus, were that oil will come cracking down. Oil did come cracking down. At the peak of COVID pessimism, when everyone had said goodbye to oil prices and everyone thought that oil will never go over $50, he came out and predicted and indicated and shared with our viewers that oil will be on boil once again. So where are oil prices headed? In last 1 year, which is 2023, oil in a sense has meandered from $98 on the top to $72 on the lower side. Now with oil prices going at $90, will it sustain, or it's a matter of time that the supply from Russia or from OPEC countries could act as a spoil spot? In China, if you look at, if you ask the Chinese, they say the oil story is over. If you ask Indians, they would say the oil story is heating up. So let's take this conversation forward. And like I said, it's an absolute pleasure to have him on the show. Dr. Fesharaki, what a pleasure, and if I may say, honor to have you on the show.
Thank you.
What is your view on crude? Short term, medium term, and long term?
Okay. Well, I am one of those people who believes in fundamentals of supply and demand. Geopolitics can change things. Paper markets can move things short term, but the fundamentals still are key, and that is supply and demand. So let's look at demand. This year, the demand for oil is growing by 1.8 million barrels per day. Last year, it was 2.6 million. So this year is slower. Why is it slower? Part of it is because last year was also a big part of it was COVID recovery. And COVID recovery is almost done, not quite. By the end of this year will be 100% done. But so this year, 1.8 million barrels per day would be the growth. You refer to China. China has an important role. Last year, Chinese demand growth was 1.6 million barrels per day. This year is only 400,000 or 500,000. Next year, 300,000. Year after, 200,000. And then Chinese demand will peak by 2027, 2028. This is a very different story from India, where the demand will not peak until 2040 or 45. And so in this demand growth, of course, the supply management becomes very important. And supply management is done by the Middle East countries, OPEC countries, plus, of course, non-OPEC countries, which are part of the same grouping, headed by Russia. So they have withheld 6 million barrels per day today from the market. So if you put that 6 million barrels per day back to the market, the situation would be very different. But they intend to manage the market, and they're doing a great job managing the market for keeping the prices stable. So we're looking at the prices $90 to $95 a barrel by the end of this year. And next year, maybe a little bit lower, $75, $85. And medium term, the demand growth continues to grow. Maybe 6 million barrels per day more demand is there to be achieved before we reach a peak in the early 2030s. And after we reach a peak, it will be very flat demand. It's not going to collapse by any means. So these ideas that somehow the renewable energy will come in and because of carbon issues, the demand will collapse, is certainly not true. Everybody promised carbon neutral by 2050. That cannot be achieved. I think India 2070 is much more reasonable and achievable than many of the 2050 stories. So basically, oil demand will peak and flatten and begin to come down. But by 2045, 2050, our demand is about the same as this year. So we don't have a situation that suddenly we are out of the oil age very quickly. It will take 30, 40, 50 years for that to happen.
Dr. Fesharaki, what about use of modern technology? Post-COVID investment has come back into the oil and gas sector. Technology has got upgraded. So do you think now for oil producing nations, the advantage of technology will ensure that the oil production actually will be better, cheaper, and technological advancement could increase the entire production capacity?
Yes, I think that is correct. In the old days, we used to look at the rig rates. If the rig rates were up, we said, okay, then the production is rising. If the rig rates were down, we say the production is falling. These things don't apply today because the productivity of the rigs have increased through technology so much that even declining rig rates can lead to increasing production. So there is oil, but there is, when we talk about the demand peaking, supply can peak a few years after that. So there is no scenario that somehow there will be plenty of supplies available and no demand, and the prices will collapse. Long term, we think $70 oil in real terms, inflation-adjusted terms, is sustainable over the next 20 to 30 years. So no expectation of a collapse in the price of oil. But the price of oil will remain strong, and all these carbon issues add to the price of oil because the carbon containment increases the cost, and the marginal cost of production in many of the developed countries, which have to worry about the carbon issues, means that actually the price of oil can be maintained at reasonably high prices. About $70, we believe, in real terms, money of today, well over $100 in the next 20, 30 years.
Dr. Fesharaki, oil in last couple of years has moved between $70 to about $100. $70 supply cuts, $100 demand increases. So do you think this time it's no different? I mean, right now Brent is at $90. Do you think it can easily go to $100, maybe $105 before it peaks out?
No, I don't think it can go to $100 or more because, as you remember, I talked about this 6 million barrels per day of OPEC excess capacity. If the prices go up, let's say through some kind of a geopolitical crisis, then everybody knows that OPEC Plus has so much excess capacity that they can produce. And because of that, they can keep a lid on the price. What is it that OPEC wants? Nobody knows for sure, but they are happy with $90 a barrel. They are not happy with the prices going below $70. So somehow the prices will have to oscillate between 75 and 95 for the next few years. In the short term, it's going to be on the higher side than on the lower side.
Dr. Fesharaki, if one looks at OPEC versus non-OPEC bloc, where one side Saudi Arabia is the swing factor, on the other side Russia is a swing factor, how do you see both these countries individually moving forward?
Well, they are in a very tight alliance, so they move together. Every time the Saudis want to have some cuts, the Russians oblige right away. And when the Russians want some cuts, the Saudis are very cooperative. So the alliance between Saudi and Russia and OPEC and a group of non-OPEC countries, this is what is working and is keeping the markets balanced. And please remember that, there is a big volatility where the prices will go to $90 and then back to $50 and then back to $80. That's been avoided because OPEC has kept a lid on the volatility and is able to manage the market within the ranges which are acceptable to them and acceptable to consumers. Consumers, let's say in India, 10 years ago, $80, $90 was unacceptable, but now the ability to pay has gone up. India can pay easily $80, $85 oil, and it doesn't damage the economy anymore. So OPEC is keeping it within a range by supply management, and that supply management has been extremely successful.
I'd like to draw your attention to the US presidential election, Trump versus Biden. It is an open secret, which is that Trump has gone on record and has said that he is in support of expansion of the hydrocarbon sector. President Joe Biden, on the other side, has actually moved the other way around, which is that he has promoted more eco-friendly stroke non-carbon expansion. So if Donald Trump indeed becomes the president of United States again, could that lead to a different approach for energy and oil prices?
Well, if Donald Trump becomes president, I don't think the policies will radically change. I mean, Donald Trump is very close to the oil industry. He wants expansion, but he doesn't want the prices to go down. So he doesn't want the prices to be up. He likes $75, $80 oil. And he would strive to try to achieve that. Something which is good for the consumer, but also good for the producers. Biden, despite his big subsidies that he's provided to the renewable energy and low carbon energy sources, he has not really interfered very much with the production of oil. So oil production goes on. Please remember the United States, the government of the United States, has very limited power when it comes to the oil industry. Everything is in the hands of the private sector. So the government can impact exports, or can, for example, restrictions on exports, but cannot tell people what to do and cannot control what is produced. So I don't see that Biden has been a big block to the oil industry, but he has been putting all the money and all the subsidies to encourage the alternatives. Trump comes in there, he would get rid of a lot of the standards, efficiency standards. He would remove what is called a Biden pause on LNG, by the way. And he would be more encouraging and supportive of the industry. But in the big scheme of things, does it make a big difference to the global market? I don't think it will.
The believers of energy transition, Dr. Fesharaki, they are of the view that the peak demand for oil comes from the automobile sector that is behind us. EVs are taking over. And if EVs don't take over, you've got hybrid as well as hydrogen-based automobiles which are going to be the future. Do you concur with the view that the peak demand for oil from the automobile sector is over and that will have greater ramifications in coming years?
Oh, certainly not. There is at least 10 more years of growth in the gasoline sector. The EVs are stories of the 2030s, they're not stories of 2020. But gasoline demand peaks first and falls quite strongly. But diesel demand will be pretty flat, slight decline. The demand for jet fuel continues to grow, no escape from that. The demand for naphtha for petrochemicals continues to grow. So the complex, oil complex, everything combined, probably peaks in the mid-2030s and drops by about 400,000 or 500,000 barrels per day every year. But that means that by 2045, our demand will be about the same as this.
Dr. Fesharaki, when you say that oil demand will peak out by 2030, but by 2030, while demand will continue to grow before it peaks out, your view is that oil prices will remain between $70 to $100. That is unlikely to change.
That's correct, because the OPEC will manage the market. It is not going to be a free market. If there is a free market, the prices can go up and down very rapidly, sometimes $20, $30 up and down. But if it is managed by OPEC Plus, that means that they would keep it within a range which is acceptable to the consumers and acceptable to the producers.
I'd like to draw your attention to India and China. You mentioned that the Chinese demand will slowly plateauing out and Indian demand will start kicking in. Now, China is a much bigger economy than India, both in real terms and in absolute terms. So do you think the drop in the Chinese demand will be compensated by India, or India is too small to have that kind of a demand or delta impact?
But let me give you some numbers. In last year, Chinese demand grew by 1.6 million barrels per day. Indian demand grew by 250,000, almost 1 to 8 side. This year, Chinese demand grows by 450, India by 250, 300. So the gap is becoming narrower as the Chinese demand goes down. But India is too far behind China to fill the gap left by China. India will continue to grow and be a very important player in the global market. In terms of the mega scale and size impacting the global market, it is still very far behind China.
Dr. Fesharaki, I'd like to draw your attention again to two geopolitical issues. One, Russia versus Ukraine. Second, what is happening in the Gaza Strip. So let's first talk about Russia versus Ukraine. From a demand and from a geopolitical risk standpoint, do you think Russia-Ukraine is more like a yesterday's headline for the oil market?
It never had any impact anyway. The only, when people sometimes misunderstand, there are no sanctions against Russian oil anywhere in the world, except in Europe and in the US, Canada and Australia. But there are no sanctions. There are sanctions on the prices that people can pay for the Russian oil. And those price limits basically have failed. And so whatever the Europeans used to buy now is sold to China and India with no problem. People who make money are the shippers, because the transportation has become much more complicated and longer distances. So I don't think that unless we have impact on the supply source, that the market will be affected. You have all these problems in Ukraine, you have the Red Sea issues, you have Gaza Strip. The price of oil has not really jumped very much, maybe $2, $3, because in the backdrop, there is 6 million barrels per day of excess capacity that OPEC is holding. And everybody knows that if there is a dramatic loss of supply, OPEC Plus will increase production to replace it.
In your newsletter, you mentioned that the world should get ready for the greatest wave of LNG supply ever. Why is that?
But the global LNG market today produces 408 million tons. Within a span of 2 to 3 years, this will jump to by 200 million tons. So it is like in the global oil market, if I tell you that oil production is increasing by 50 million barrels per day, everybody would shudder. But this is the similar scale, that the increase in production is dramatic. But the demand for LNG is not going to peak, not until 2050, and even then it will be flat. So because of that, this additional huge volume which comes will create a surplus for a number of years. But after that, we will have another round of shortages. So the price of LNG will be going up much more up and down than the price of oil, because there is no OPEC Plus to manage it. It is very much in the hands of the market. The LNG is sold on 3 different ways, either by oil indexation. In that case, OPEC is important because they have an impact on the price of oil. Second is by indexation to the Henry Hub in the United States. And third is by spot price. In Asia, 80% of the sales of LNG are by long-term contracts, only 20% by spot. South Asia, Pakistan, India, Bangladesh depend more on the spot. So it may be good news for them that the spot prices will go lower down post 2026, and that they can come in, but these will not last, because a lot of new demand gets generated when the price is low, and that would push the prices up by itself.
Dr. Fesharaki, it is also believed that there is going to be a renewed focus on gas as an alternate source, which is especially for power plants, where thermal-based power plants are getting replaced by gas, which is considered to be a much cleaner source of production or source of energy. Do you see this impacting gas prices exponentially in coming years?
Actually, in the power sector, gas and coal have already replaced oil. So there is very little oil-fired plants. In the United States and Europe, it's zero. And in Japan is next to zero. In Korea is next to zero. In India, it's still very limited. Coal still plays a very key role. But the tragedy in India is that there is 30 gigawatts of gas-fired capacity, which is not operating because the price of gas is deemed to be too high for the consumers. And whatever scenario we think about, coal is always cheaper than gas. You can't make gas compete with coal. So only the environmental regulations will force more use of gas as compared to coal. But oil is already out of the game. Oil is for industrial sector and is for transportation sector. Insofar as the power sector is already lost the game some time ago.
Dr. Fesharaki, meanwhile, we continue to focus on Russia and OPEC and what essentially Middle East producers are doing. US also has surplus oil. They are net exporter of oil now, and the capacity is much more than what the demand is. Now, US is world's largest economy. They are the ones who are dominant in terms of taking a big step forward in terms of which country can export, which country cannot export, because they use this whole hammer rule of what could be called as sanctions. So given that US has surplus oil now, how do you see that changing the dynamics?
Well, let me clarify that the US still is a net importer, not a net exporter. But the US oil production is about 13 million barrels per day, and consumption is nearly 20 million barrels per day. So still a lot of oil is imported in the US. The question is that in the US, most of its own oil is not used by its own refineries because they prefer to export it because the quality is not matching the type of quality of the crude that the refineries need. Refineries need heavy crudes, and a lot of US oil is light crude. So US, if you add the crude and petroleum products combined, US is probably the largest exporter in the world, but also the largest importer in the world, or close to the import levels of China. But at the end of the day, the US government has no role in the oil and gas sector. The government controls the flows by sanctions. The US government power is outside the US, not inside the US.
Okay. And final question, Dr. Fesharaki, you've been making a case that the golden era for refining is coming. But if one looks at GRMs, the trend in the GRM actually is November, they were at $4.9, they went up to $9, and they've come down again to $4. Why is there so much of volatility in global refining margins?
Well, what is happening, I mean, $4 or $5 is great. When we have something like $9, which was in 2022, and we look at that, and that's the wrong benchmark. Those things happen for a variety of reasons on a temporary basis. But GRMs are pretty strong. Gasoline cracks now, it's $15, $20 a barrel. Diesel cracks are in double digits. So the refining business is doing pretty good. One of the unexpected developments, which certainly we didn't forecast, is the accuracy of hitting the Russian refineries by the Ukrainian drones. Up to 1 million barrels per day of Russian refineries are out of commission. And this means that Russian exports of refined products have fallen quite dramatically. And that has helped the margins. But the key issue is that nobody is building new refineries in the world today. And demand still has 6 million barrels per day to grow before it peaks. So in that environment, those who have refineries will benefit. And in India, there is lots of expansions taking place, substantial here or there. But there is the big refineries like the West Coast refinery, those ideas are already there. Nobody's looking at that anymore. The big grassroots refineries are not going to happen. And if you look at Reliance as the very economically conscious company, they are not planning to build any more refineries. They're trying to go more into petrochemicals and into hydrogen. So the key issue at the end is that when you don't have new refineries coming in and the demand is growing, it does create a golden age for refining, at least for a period of 2024, 25, 2030. After that, the golden age will disappear. And still, the margins will be okay, as many refineries in Europe and US will end up closing. But in Asia, outside of Japan, and some key refineries in China, everybody continues. Nobody thinks about shutting down a refinery in India. Refineries in India are often run at above 100%, which is unusual. Nobody else in the world does it like this. So India is short, and either has to be supplied by Reliance and Mayara, or has to import. But the markets are very brisk in India, and the refining companies in India make plenty of money.
Fesharaki, always a pleasure to have you in VT Now. Thank you for your valuable inputs, and thank you for really outlining the factors which are at play, at least for the energy market.
My pleasure. Thank you.
Thank you, sir.
If you like this video, then like, share and subscribe to ET Now.